people like kind of poke fun at Glenn Sanford and EXP with their virtual world, but I'm like, yeah, it's kind of Donkey Kong-ish right now, but it will change over time and it will be impactful.
You talk about it privately, we talk about it publicly. This is the Real Estate Insiders Unfiltered Podcast. Welcome again to the Real Estate Insiders Unfiltered Podcast. I'm your host, James Dwiggins, along with my co-host.
I didn't get my Dwiggy?
No, I just wanted to see what you'd say. So,
I live for the Dwiggy.
Mr. Keith Robinson, actually
Yes,
just
sir.
screen named Keith today.
Yeah.
We had our dear friend John Campbell back.
Our quarterly visit.
From his quarterly visit on the earnings report. Wall Street analyst at Stephens. Keith, just give a quick rundown on what Johnny had to say.
Yeah, I love it when we get to have him once a quarter just to unpack all of the publicly traded stocks that he covers or pays attention to. We ran through the normal list of companies that he evaluates, and we got to also ask him some questions. Of course, we picked his brain on the election, what he thought those results would be for the future of residential real estate. We talked about when senior officers sell a bunch of stock and how does he think about that as an analyst? And then what happens when a key leader steps down and how he thinks about that as an analyst as well. So not only did we cover the highlights, but we also got to get behind the brain of an analyst a little bit, which was super fun. You're going to dig it. Put it in your ears, kids.
John, welcome back to the show. We are in earnings season. We always love having you back on here to talk about how Wall Street looks at the world. And we got a running list. Just again, in case anybody doesn't know you, 30-second. Who's John Campbell? Real quick for everyone.
How could they not know?
So John Campbell is a research analyst at Stephens Inc. An equity research analyst, essentially a Wall Street analyst. We pick and choose stocks. We put buy ratings, sell ratings, hold ratings, price targets. We here at Stephens, we're one of the largest brokerages off of Wall Street. We cover hundreds of stocks, got lots of different analysts scattered across multiple different sectors. And so I am focused on real estate in general. Predominantly real estate tech and real estate, kind of disruptive technologies and the brokerages as well as the title insurance. So we cover kind of the housing value chain. So we start off with Zillow at the start and then move through everything from the brokerages. We used to cover, before they were acquired by private equity, a lot of the mortgage technology players. Sure. We cover title insurance on the back end. So I think we got the full kind of spectrum. That's definitely different than Wall Street. Wall Street, you're going to be a tech analyst that covers multiple different industries. We predominantly focus on real estate. So John
is the guy in the back of the room you didn't know existed.
That's right.
At the conferences.
That's
about all the stuff.
That's how we got to operate.
He got a fresh haircut and glow up. John's looking aerodynamic. Let's go. He's ready.
Getting ready for his beanie.
ready for the military. Yeah.
All right. Well, first question out of the gate, right? Like, I don't know if you knew, but recently our great country had an election. Can't get a stock analyst on, especially one with an expertise on residential real estate, and not ask your thoughts on the election. What do you think this means near, medium, long term for residential real estate companies that are in, around, or touch residential real estate? Overall thoughts, election results for real estate.
Yeah, I think from the academic standpoint, it feels like a net negative because you've got kind of inflationary pressures that potentially reemerge. The degree of changes on tariffs, that's going to have massive ripple effects. However, Trump wants to take over the Fed. He wants. Oh gosh. So Trump's going to give us 3% mortgage rates no matter what, despite every. No, I'm just kidding. I don't think that's going to happen, but I don't put anything past him. You're right. And so, like from an influential standpoint, he has long been pro real estate. So I think you've got to keep that kind of stuff in mind. So. Yet to be determined. Obviously, the short-term rates have risen. You've got a pretty bad situation for a couple of these companies who, and in particular, like title insurance, who has investment income, where you're going to have lower short-term rates, potentially staying long, higher long-term rates. And so we'll have to see where mortgage rates go. What has been very encouraging, I'm sure we'll talk about some of this stuff, but of late, and this is not enough time to really get very bullish and view that as an ongoing trend, but like coming out of election stuff popped, right? We're seeing everything we're tracking. And I would love to get you guys.
Oh, I looked at my 401k.
Yeah. Well, I mean, I'm talking about just in housing in general, right?
Joking.
On higher rates. I mean, I think we're at a point now where how much pent-up demand has there been, right? How much was held back around the election because, it did for periods of time feel kind of like a coin flip, right? And so there was a lot of uncertainty, right? If this is a binary event 50-50, I mean, that's the definition of uncertainty, right? So, I feel like you saw those people. I mean, I think this past weekend, Redfin said that, 25% year-over-year increase in home tours and buying activity in their index in general, right? So
I have heard the same thing from some people. Last week, Keith and I were in Boston at the National Association of Realtors conference, and I had some of our brokers mention that since the election, there's been people that have been calling now saying, "Hey, we want to go look at property," like it was holding them back. So
so I'd put that all in, and to answer your question succinctly, I don't know what Trump means for the, for the housing market. I think he probably does mean higher for longer rates on the 30-year rate
because of tariffs and sort of the general direction of how that's essentially inflationary. So
right. And now you're talking about, cutting the deficit. We're going to talk about less government spending. That probably means less of an impact of buying, mortgages and you take that out of the market and investors are going to push that rate higher.
So a lot of this, just your take on this, the real estate industry is incredibly hopeful that Trump, how do I put this, reins in the Department of Justice. And he certainly is not a fan of them. And so that will also potentially, pull back some of this investigation and pressure on the real estate industry. I've had to caution people to remind them that this actual investigation started during the previous Trump administration, so not to put so much hope in that. Is that all being played into anyone's conversations out there too?
I don't think you can clearly see it in the brokerage stocks. They've been down, even more so recently. And I think that's on rates. I don't think that's part of the narrative. It's not part of the consideration. I'm with you. I think there's an outside chance that, maybe it doesn't go away, but like
reins them in a little bit.
Right. It reins them in a little bit. And I think that's a good way to frame it. Because it feels like, they had pretty much open reign to do whatever they wanted. Right. And so I think this does change things a little bit. I don't expect it to go away though.
Yeah.
Okay.
Yeah.
All right. Well, let's go down the list. We only get you for a certain amount of time. Let's start with Zillow, since you mentioned them, that you start at the top. So let's go through earnings report from Zillow, and there's obviously some news there, but I'll let you start. I know Keith's got some questions around that. So
yeah, for sure. Zillow, I mean, last quarter, same situation. This has actually been a continuation of the last couple of quarters where you're putting up big outperformance relative to expectations. Now, granted, they are providing their forward look guidance a little bit, and they take numbers down, just come back and put up meaningful beats. That's the typical Wall Street game. They've done it really well. They have not really had much of an impact or much support from housing. I think it actually kind of worked against what they were maybe expecting a little bit this quarter. But a big overall beat quarter. Stock was up 25% post print. It was up 20 or 18% last quarter. It feels like the momentum is there. This is the 5th straight quarter of kind of accelerating growth for them too.
Is most of the growth in the ancillary services space for them, or is it across the board?
That's clearly like mortgage. They are rocking and rolling in mortgage. Their purchase volumes were up, I think 80% year over year. So a lot of self-help, a lot of share gain there. Rentals business for them is still very good. They've kind of unlocked a new strategic focus there where they're focusing more on kind of professionally managed multifamily, larger customers, right? And they've always kind of done well in the long tail, like the small single family, rental stuff. And so that's been a new growth driver for them. Their core business is doing really well, right? The residential business is where they house Premier Agent now. They don't report on that directly anymore, which kind of sucks, but I think we got a pretty good grip on what that looks like. That business grew, I think 17, 18, 19%, something like that this past quarter. You've got a chunk of that is acquired revenue. Remember they acquired Follow Up Boss,
right.
And Aereo and some of these, and Spruce and some of these other businesses. So you're getting a little bit of benefit from that, but net, I mean, they are handily outpacing the national market. And a lot of this is due to their enhanced market expansion. I'm happy to run through all that. That's a bit of a long conversation, but just know that they have now expanded to 43 markets. they're expecting about a fifth of their connections to run through those enhanced markets. And those enhanced markets are kind of the playbook going forward. So this is kind of moving from pilot to expansion. This will be the new Zillow model over time.
Keith, go ahead with your question. I got a follow-up as well.
For sure. So recent headline, like really recent, Zillow president steps down. Susan Daimler. I actually have not had the pleasure of meeting her.
I have.
But yeah. So
she was with Street Easy. That's where they got her, I believe, when they bought it.
So I guess specifically, what does that mean when an analyst hears about a senior officer stepping down? And then, so specifically to her and Zillow, and then in general, as an analyst, how do you evaluate that? Or does, if the stock's tanking and someone leaves, then that probably is a good thing, right? And if the stock's ripping and someone leaves, what does that mean? So just unpack that for us.
Yeah, I think she is incredibly well respected in the industry. I think she's done a great job at Zillow. I don't think she was necessarily a lot investor facing. So I think people see the title and recognize she was important there, but I don't think they spent a lot of time with her.
Yeah.
What I would say is when I see that an executive's leaving, I immediately ask why. And I look at the circumstances and outside of just calling the company, like, why is she leaving? You're wondering if she was terminated, right? And it was a peaceful termination that allows her to save grace, which I don't think was the case. But sometimes you can see from effective immediately versus, hey, we're paying, they're going to stay on to the end of the year. And then they're going to a consultant role for another year. Like that was the case for this one. I don't know if you guys also saw, but maybe it was, I can't remember the other Daimler, but it was, I'm guessing her husband, brother, whatever, same last name. Maybe it's a coincidence. I have no idea, but they included that in the same language in the release, which I'm guessing is her husband. And if they both left at the same time, I think they've probably both made, and particularly her, very good money over the years.
Yeah. I hope they're going to like Tahiti to live on a beach somewhere and just like reconnect and fall in love. That'd be amazing.
That's right. That's right. So Zillow stock has done really well. And and you can, that helps that whole relationship a lot.
One follow-up. I mean, Rich, obviously Jeremy Waxman's now the new CEO. So that happened a month and a half ago, roughly. And then, but he's been obviously a long time as a CEO prior to that. But then Susan, does that add any is it still the same thing? It's kind of like,
I mean, it's kind of a refresh of the management team, right? Obviously Raskoff been out for a long time and Rich kind of came back, and I think he was there and kind of waiting and to find a new CEO, and he ended up staying on because housing went crazy and crazy to upside then crazy to downside. So I think as we sit here today, and they got a new CFO too, right? Like keep that in mind. And so as we sit here today,
interesting. Yeah.
I feel like this business is on better footing than maybe it's ever been. Right. And it feels like we're at the tail end. Like who knows when housing starts its real sustainable recovery, but there's like all these strategic changes, all the pivots, getting out of iBuying, doing the enhanced market, doing the super app, all these things are kind of like coming together. And so if you're a leader that cares a lot about this organization, if you're ever going to leave, now's kind of time to do it. You hand over the baton and it kind of, it's not on autopilot, but things are, all the heavy lifting's been done. Right. And so like, to me, it feels like kind of a natural transition.
Yeah.
So we'll see.
Sort of my work here is done. So, I've successfully gotten it to here. It's time for someone else.
And by the way, I'm really happy for Susan. If that's what that is, that's fantastic for her.
And absolutely.
All the tenure she's had.
And the reason I say that, I think that's probably her decision, is that she's staying on in the year, and then she gets like 50% of her salary all the way into like middle of next year as like kind of staying on more consultant type role. So I think it is probably
elegant transition. Right?
That's right. That's right. That's right.
Yeah.
All right, let's go the other way with this real quick, and then we'll move on. We got a lot of stuff to cover. CCP. I'm assuming this is a concern that you're watching. I think there's not much of an argument that
I heard Zillow was going to be the new MLS. No,
we'll leave that out of it for a minute. Don't get James on a rant. Genuinely though, CCP going away would not be good for real estate portals. What is your take on that? I shouldn't be putting words in your mouth, but I'm assuming you're going to say the same thing. So,
not good for all portals is the way I'd frame it.
And I didn't mean to Zillow, but for all of them.
I think particularly for Zillow, it's not good.
Yeah.
I think
anyone who needs the data.
I think starting there, you've had lots of people who have had angst with Zillow for years, and this is their opportunity to take a shot. Right. We'll have to see where CCP goes. This is something, I mean, we are deep in this industry like you guys are. So like we have been on CCP ever since the PLS cases, right? I mean, like this is something we've been tracking closely. Wall Street is just now paying attention to it. You can always tell because if you got analysts at these other big bulge bracket shops that I compete with, who cover 40 names and they don't pay attention to Zillow, when they start asking questions about CCP on earnings calls, you better believe that all the investors are paying attention to it, right? Because it finally has made its way to the surface. And so here we are. Go through any of the earnings calls, you'll see that. I've got almost all these companies in Nashville next week at our annual conference. And I will be asking about CCP. There's been some who have been larger players who've been less vocal, and I'll put them on the spot and ask them to take a side, right? Like Real Brokerage, for example. And so, yeah, I think it is a potential big benefit for people like Compass, right? That's very obvious. This is why they're very much self-interest, right? In their approach here. I think if it does get eliminated, I think you could see homes.com as a very big winner. I think people will gravitate. I think you will see listings arrangements. I think if you see one of them from a large brokerage, there will be more that come. So we'll have to see where all that goes. Zillow, I think has a good chance where they could be a part of that too. But like at the minimum, if CCP gets eliminated, you will see less inventory on Zillow. And I will say that with 100% certainty.
Categorically, right? On all portals, right? Like that not just them, but
it's not. I mean, it's not great for consumers. And I get
awful.
I get the argument. I get the argument on the other side where seller choice, every bit of the rules and regulations are kind of geared towards the buyer. But like, man, I mean, like, who does disenfranchise the most? Well, probably low income buyers, minority buyers to some extent. Like, this is not good from a fair housing standpoint. And I think I don't know if there's any way around that.
Well, and it's also, just to nerd out for just a second on the actual like tactical selling of a home. When a buyer is given the full depth and breadth of the information, they're empowered to make their best offer. Right.
Yeah.
And it's worth what it's worth, and it's going to come out on inspection anyway. So it sounds inverted, but the more you can communicate with a buyer and remove the mystery for them, the more confidently they write their highest and best offer. And so while that logic sounds like it makes sense, buyer beware, figure it out on your own. Why am I going to give them all this information? Well, it's self-serving. The reason you give them all this information is so that they can write their best offer confidently.
Yeah.
Yeah, also, I mean, you mentioned this, but I mean, I'm going to add, it's also incredibly good for the seller.
Yeah. No, it
John,
is. That's my point.
You were just mentioning the benefits the buyer. I'm like, benefits the seller. I was saying this, Keith and I were rapping about it yesterday. And I said, Next Home as a company has sold several 100,000 homes in the past 10 years. And as the CEO, I can think of 0 times a seller has ever emailed me saying, I'm really pissed off your agent put my home on the MLS.
Yeah. Right. There's too many people looking at it. I have too many buyers lined up. Like, get out of here. Right.
Just get out of here with your stupid logic. So, all right.
Next up,
let's go down that list. You mentioned Compass. Let's talk about them real fast. What's your take on everything there, especially since they're very vocal about wanting to do this?
Yeah. Compass is up. They came out of, another good earnings report for them. They've really turned the direction of profitability, right? They almost, a little bit over doubled up EBITDA year over year, which is an important metric for investors.
How much of that, sorry to interrupt, but how much of that is growth and how much of that is cost cutting?
It's a little bit of both, I'll tell you. Go to my almanac here of all the,
Can I get your almanac, bro? Like, can you just send that?
You got to go back in the DeLorean to 1990. So Compass's revenue was up 12%. So there's a portion of that. They got
not nothing.
A little bit of leverage, right? But a big chunk of that is cost saves, which is fair.
What I thought.
But and some of that growth is driven by acquisitions for them.
Sure.
They've done some pretty big land grabs.
It's a good time to acquire. I mean, and they're smart for doing it. Like this is the best time to acquire businesses when everyone is struggling. So, long-term perspective on them. And we didn't ask this. So on the Zillow side, I'm assuming you're a buy. And on Compass?
Yeah. So I don't officially cover Compass. What I will say with Compass though is, if you're looking to play a macro play, right? Like if you're trying to play U.S. housing and you look at a lot of these names out there, the home builders, the mortgage originators, a lot of them done well. These guys, the brokerage space has been weighed down so much by the lawsuits and uncertainty that there's still opportunity there where you can get a pretty big lift on the multiple, right? And then, if you've taken a 3 or 4 year view, you're playing U.S. housing as a thematic play. This is one of the cleanest pure plays out there.
You mean because it's so close to the consumer? Like you're literally in
right, and like you could do anywhere real estate or house. Nasty balance sheet. Redfin, a lot of things going on there. Not a great balance sheet. Remax, bad balance sheet. They had to pull their dividend, right? Like this is the cleanest way to play it. Really good balance sheet. I think a good management team. They are still garnering share, whether they're paying for it or not. I think they're still growing organically. They've got the cost all, like that was a big issue in the past is they, were envisioning being a grandiose technology company. They still have visions of that, but they've cut out a ton of costs. Right. And to their benefit, I do think it costs a lot to build something. It costs less to maintain it. So they built their platform and now they're maintaining it. Right. And then the big thing for Compass is the narrative. You hear me say narrative when you think about a multiple. That's kind of that's the sentiment that investors are willing to pay for every dollar of earnings or dollar of revenue, right? People are willing to pay more for Compass now because they think there's something else there, right? And one of the biggest issues in the space for forever has been splits, right? Agent splits have just hammered the economics of a lot of these brokerages. And so if there is something there that could change that, you got to give it some kind of consideration. You're willing to pay a little bit more if there's a possibility, right? And I think CCP is probably that possibility.
All right. Do you cover CoStar, Homes.com?
Yeah.
So let's go there.
Yeah. CoStar has been kind of tough. If you look at the stock, it's set in this band of 70 to 80. Any other company that would wipe out earnings as much as they have to reinvest for as long as they have, the stock would have gotten annihilated.
Hammered, right?
CoStar is a art collector type stock. People want to own it long-term. Long-term investors want to be there, right? And so you got some support there.
That's a good one.
Homes.com, it is a bifurcation, or it's almost night and day in the sense that the good side of things is they set a really good foundation, right? They've got the traffic, they've got the content, they got everything they need there. The bad part is they're having trouble selling it, right? And that's a big issue, right? If you look at their bookings, so what they report is net new bookings. And for those on the listening in on this, a booking essentially is a forward indicator for revenue. Like if you if you sign a 12-month contract, you're not going to recognize that revenue, but a little bit over time, the booking lets you know what that's going to be 12 months from now, right? And so when bookings start to decelerate, revenue growth inevitably will decelerate, right? The first quarter they came out with bookings, and this is a net new bookings number, right? And so it factors in attrition. And so when you launch a new product, the first quarter you launch that, it is a gross booking. It's a gross, right?
Right.
They crushed it in 1Q, like 35 million of gross bookings. Fantastic. The next quarter that dropped to like 19 or something like that. It came in this last quarter like a 1 to 3 million, like single digits million.
Now that's
attrition.
Is that because the churn?
That's the churn. The churn. Yeah. And so like, I do think from a gross ad standpoint, you're probably slowing a little bit there. I think initially when they came out, there was a little bit of like favorable pricing, stuff like that, but also you're going to get your first movers. You're going to get the guys who buy the Apple Vision Pro the day it comes out, right? They got on board. And I think that they were kind of pitched the product the wrong way, which is like, hey, we're going to target initially all the agents who've advertised like crazy on Zillow or Zillow and Redfin and Realtor.com. That's the wrong group, right? They're accustomed to buying quantity of leads. Like they ascribe the value to quantity and not quality.
Yeah. Right.
And so when you're paying the same on Homes.com and you're getting a fourth of the leads, you're leaving, right? And they were also very lenient in their contract terms. So you could sign up and cancel the next day. And sure enough, people were doing that.
And I'm gonna slightly defend them for a minute. Not that I'm in their camp or anything, but it is a hard market, and there's not a lot of money to go around right now. So like people, there is only so many houses going to be sold, and that is, we have, as you've probably seen the numbers, the agent population has not decreased that much. Although I'm still believe that's going to happen a lot next year. But I just don't think there's the revenue. I mean, we were at the NAR convention last week in Boston, and it was sparse.
Yeah. I think that's fair. And, I think some of this is also, CoStar they came out and they spent exorbitant amount of money initially right off the bat, right? Like 100 Super Bowl commercials, like those are expensive. We're talking about when you do the production costs and all that stuff, $10-15 million a spot.
Yeah,
right.
I know, I was there.
And then the search engine marketing spend, which drives traffic to the site, like they went for it, and then they took every one of their salespeople, so 1,300 salespeople. I don't care if you were selling the core CRE data product for the last 20 years, you were selling homes.com. They threw everybody at it, right? So it came out to a big splash. But the problem is a lot of those sales reps were the sales pitch was, hey, you're listing your lead. We're not Zillow, right? There's more to it than that, right? You got to think about like impressions. Like this is why you sponsor a T-ball team. It's not to get a home sale the next day. It's it's branding, right? And I feel like some of that angle of the pitch just wasn't there. So I think they've corrected that to some extent. And they've also got more account reps, right, who are hand-holding, like explaining what the product is, which they should have had from day one. And then they're going to like triple up the sales force, right? Throw more bodies at it.
So where are you at on them?
I'm a buy. I love CoStar. I love the core business, particularly. That business has held on really well despite very tough, CRE kind of macro conditions. I think they're in position to reaccelerate that core. I would say the vast majority of investors are buying the business for the core. Resi is viewed as kind of optionality. There's not a single person I talk to that's excited about Resi right now. So like the opportunity there to drive the stock higher if they get it right is there for sure.
Right.
One last question, Keith, unless you have any. We're interviewing the CEO of Matterport here coming up, and what's your take on that with that acquisition?
Oh, I love that acquisition. If they can get it across, I think they'll be able to get it across the finish line. It is in its second review. I think you can point to Matterport as being like one of the critical providers that got us through the pandemic, right? Doing virtual tours and stuff like that. They were important. So I do think have a very important spot in the ecosystem. So that's probably where that review is coming from. And I think, they don't want CoStar to acquire it and then turn it off to the rest of the industry.
This is the feds agreeing to the acquisition, just for clarity.
Yeah. So the FTC, if they launch a second review, it's basically like
what are your intentions?
Reviewing them.
I just wanted to, for the audience and viewers, for clarification on it.
And so I think there's a lot of stuff they're going to do with that. They're going to transform every property, both on the Resi and CRE side, into like digital twins, right? And create that. And like, I hate to go too far out here, but like the whole idea of a metaverse and walking around with virtual reality, like that's a real thing, real potential for them.
Man. I've seen some cool shit on that, John. I've seen some cool shit on it where like you're immersive and you like, that's the couch. I want to buy that. Oh, that's over at Bloomingdale's. Like, I mean, it is cool shit.
That's it. And people like kind of poke fun at Glenn Sanford and EXP with their virtual world. But I'm like, it's kind of Donkey Kong-ish right now. But it will change over time and it will be impactful, right?
He's going to be so offended you said that, by the way, because do you know that?
I actually stole that from Gary Kelman. So
you know that he used to wear the Donkey Kong shirt. There's a hit. I'll explain it to you offline. There's a thing there. All right, let's go to the last portal.
And the last thing I'll throw out though, James, is like when you talk about the Matterport, the ability to tag stuff in homes. Yeah, that is coming for sure.
Yeah, I know. Yeah, right. So it's going to be huge.
But since we're on the Matterport piece, when I first read it, that number that they paid seemed really big to me.
1.9?
Yeah.
Was 1.9 billion, right? I think 1.9 billion.
Is it because it's got so much, like they can use it
in stock, but
but they can use it across the whole spectrum of their business, right? Is that
why
that price?
Much more of a technology, like a homegrown or a technology play than it would be like a revenue, like a accretion play, right? And they are they are spending a lot. So there's a commercial margin there that gets eliminated. So like there is some cost synergies there. But I think Matterport, I can confidently say, I think that will be one of their most transformational deals they've ever done. I really do.
And
maybe it wasn't a lot then.
Just so all the viewers and listeners know this. So I got a chance to hang out with RJ, the CEO of Matterport. I just wanted to pull this real quick so everybody has context. Prior job, Senior Vice President and Chief Product Officer at eBay. Prior to that, Head of Worldwide E-commerce Platform for Apple. Prior to that, Director of Product Management at Google.
So
this guy is wicked smart.
Wow.
So his parents are proud of him. Is that what you're saying? His parents are proud of
him, and I got to spend about an hour with him recently. We were on a pod together, and I was like, "Oh, this guy." What my point behind all of this was, it's not just Matterport. They've got talent acquisition there, and that guy behind that, as well as in that CoStar group, is going to be really interesting to watch. So
yeah, agreed. And like if you're like a Wayfair or something like that, like that's troubling.
Yeah, this guy, worldwide e-commerce, like this guy thinks way differently than everybody else.
Yeah.
So, all right, let's get last portal / brokerage, and we'll move into the Remaxes and EXPs, et cetera. So Redfin, and we've got 20 minutes. So we got to knock these things out somewhat quickly. Okay. So Redfin, tell me your take on Redfin. You were bullish on them a little bit in the last call.
I still am. Housing hasn't been as good as I was expecting initially, to be honest with you. That model has a lot of torque to housing for sure. I'm still a big fan of Redfin Next. They're now rolling that out across. I think last call I might have been hinting that I was thinking that they were going to do that. They're doing that now for sure, nationwide.
Just in case someone doesn't know, Redfin X is
Next.
Yeah, so Redfin Next. So essentially, everybody knows Redfin's like one of the only scale players that's a W-2 salaried, agent model. They're going traditional, right? And so now agents, when they source their own properties, their own sales, they can get up to 75% of their commission dollars. It's still going to be, I think, probably 40 or 50% if it's sourced from Redfin.com.
Right.
A lot of their deals are sourced from Redfin.com. I do think this opens up the whole gamut to open up and go luxury agents, go higher end agents, higher producing agents. This opens up their recruiting channel in a big way. Because not only are you getting what you're accustomed to using on splits from deals you get yourself, but also you're getting salary, or you're getting benefits. Right. And you're getting, you're getting the leads from their website, right. And you're getting technology, right. That's all covered under their operating expenses. Right. So it does feel like you kind of check the box on a couple of different fronts. So that's why we got really bullish on it, is I think this model pivot should have happened 20 years ago. Right. I think I can see the idea of getting scale and leverage and forcing, like agents to have feedback loops to their software, creating software for those. I get the whole concept. It's just hard in a very cyclical and a seasonal market, and so this will help them really smooth out their P&L statement, right? Where gross margins aren't going to be going all over the place because you got fixed salary and seasonal periods. So we're bullish on it. They missed a quarter. They came out this year saying that they're basically hell or high water. They would go profitable or break even EBITDA. They're going to fall short of that. I think some of that was weaker housing. I think some of that is also the transition costs, because going from a salaried model to, variable pay, like you can't just tell everybody who's getting paid, hey, you're not going to get anything.
Right.
Now.
It's not a light switch.
Yeah.
Right?
Good luck paying your bills the next 3 months. They have to help make them whole to get them over the chasm to start the new process.
Yeah. Okay. Well, let's go to, we've got 4 left here. We'll start with Remax.
Remax was able to grow its agent count year over year after falling last quarter. It was the first time that has happened since like inception, right? A lot of that growth is coming from international agents, which they just don't get. Like if you look at a revenue per agent for Remax, it's like a fraction of what the US agents are. So it doesn't really move the needle that much. They seem to be struggling. I just feel like they're kind of in this no man's land where the model's too expensive for a lot of people. And, like it's always been too expensive for lower end producers, because you got to hit a certain number of deals per year to even cover the cost that's required to be a Remax agent. I think the brand is still very good and important. But US agent count has been on a perpetual decline for years, and I don't know what they have cooking right now that really stopped that, so it just feels like, like I've mentioned with the debt, you've got minimum, debt service payments now that you have to make, which one of the restrictions is that you cannot pay a dividend anymore, and that was always a hallmark to the Remax story, is that you had, this steady agent growth. U.S. housing's a little bit of a support, 5, 6, 7% a year. And you just grew earnings steadily for like a decade, and you were paying a healthy dividend, 4 or 5% yield on the dividend. Fantastic. It was like a small cap darling at one point.
Right. Made a lot of sense.
Yeah. And they are like, just to be clear, they're a franchisor, right? They're closer. They're more akin to like a Dunkin' Donuts than they would be to Anywhere Real Estate, right? So people love that model, willing to pay a high multiple for it, stuff like that. And when agent growth is your key growth driver, right? Because they're paying annual dues and stuff like that. That's driving your subscription revenue. When that stops, the whole machine slows down, and that's the challenge you're facing.
You buy or hold, or where are you?
I'm a hold on Remax. Yeah.
Okay.
Really, G? Anywhere? I mean,
anywhere, man.
That tells you how old Keith and I are.
Yeah.
No, I call it. I mean, at least you're not calling it Send It. Right?
We did. Yeah, I was about to say, if we call it Send It, we're really
old.
Yeah.
I was around then.
Speaking of Send It, this management team was thrown under the bus by the actions from Apollo and Send It back. Like they literally acquired this like the day before, like, Lehman Brothers went under, right?
Yeah.
I mean, like the world changed. So like, as you're projecting out, this will be 4 or 5 times, leverage ratio. It went to like 11 or 12, 13, 14, right? Like things just went crazy. And so they've been paying for that since. I think they've done a great job of terming out or pushing out some of those maturities, right? So the debt maturities, when they're actually gonna have to pay them off, pushing that out a couple of years gives them more breathing room for housing to come back, to continue to cut costs. The way I'd say it is, I think they've done absolutely everything they can. They've sold off pieces of the title business. They tried to sell off Cardus. COVID hit them there and like broke that deal. I mean, like it's been kind of a Murphy's Law situation for them. We're a hold on it because I just feel like, for me, if I'm going to play U.S. housing, like there's other ways to play it that are cleaner. I do think it will kind of ebb and flow with U.S. housing. Like you can almost, this stock, wherever you tell me existing home sales will be next year, I'll tell you what the stock is, they've put up, a little bit of a squishy quarter. They've got a good wrap though on splits. That was a big issue for them, right? Like if you'd have taken, I think maybe 2 or 3 years ago, I ran this analysis, but if you took all the home sales they did in that year and put the split that they saw in like 2014 or 15, it'd been like 500 million more of EBITDA, like massive, like more than the whole category combined in EBITDA is what you've lost, right? Compass was a big issue there, right? Like Uncle SoftBank being able to throw, blank checks at producers. That's
hard to compete with.
I want an Uncle SoftBank.
You got Uncle Keith there. Look at him there. No, what I would say is, I mean, I think they're doing everything they can, and splits are very, very modest, like very manageable. I think they were up 10, 15 bip year over year, like very manageable. But, I think they're past the worst of times. And, I don't think they've had an agreement with Compass to have a stand down, but I think they're both kind of like, all right, like taking
a breath, take a round off. Let's take a round off.
Yeah. Like go easy, champ. I think that's the case.
Yeah.
I guess my last question on that, and then we'll go to the last two here, is do you feel long-term that with all of the lawsuits and turmoil and just everything going on, that traditional splits are still going to be a problem for all of these companies as we move towards a more automated world? I'm just trying to think 5 years down the line when we've got a lot more AI doing a lot of things, where do these businesses go?
I think you will see consolidation. I think it needs to happen. I think people need to get into behind the closed door rooms and say, hey, like we will be stronger if we're together. I think that needs to happen. I think that needed to happen years ago. I don't think splits are really going to change that much, because a split essentially is your gross margin, right? It's your cost of goods or cost of revenue, right? That if you don't have the agent, you can't be consumer facing enough. Redfin's tried it. It's hard, right? To be consumer facing enough to really direct the flow, right? And garner the economics. So you have to depend on agents. And as long as the industry is as fragmented as it is, there's places to go. Who's going to be the guy who stands up and says, hey, my 10,000 agents, I'm sorry. I know everybody's kind of averaged out about 75% split. You're going to go to 50. What's going to happen? Revenue goes away, right?
Yeah.
And all that fixed cost you have, kills you.
Yeah. It's harder in residential real estate when, not to speak about humans in a harsh business sense, but when your assets have feet, right? When they can pack their desk and leave.
Right. They'll vote with their feet every time.
That's right.
I think that's right. Yeah.
All right. Last two here. EXP. And I know Keith's got some questions here as well, but EXP, give us your take on that real fast.
Yeah, they've from an agent count standpoint, they were once like the darling, right? They kind of created the category of cloud-based brokerage. I think this last quarter, real brokerages agents are up like 79% year over year. EXPI down 4%. Like that's been a continuation of what we've been seeing. I do think a lot of the loss of agents for EXPI has been the true hobbyists, like those who are closing 0 to 1 transactions a year. And so I think, in the way you can see that that's probably the case is like from a revenue standpoint, like their average revenue per transaction, all those metrics are improving a lot. And it's because you're reducing the denominator there. Right. And so I think a lot of it's been that they have really kind of turned the dial a little bit on the cost side. Like they've cut costs. I think they were like 20 million or so of costs this year that they were going to go capture. So I think they've done what they need to do, kind of like Compass, in that, like revenue growth, like has a lot of opportunity to grow over the years, but like in this period of difficulty, like they've really shown that they can tighten the belt, so I think that's kind of important. If you're a long-term investor, like the incremental margins, and I know this from my days working at FedEx, like I was working on a strategy team at FedEx in 08, 09, and we spent a year identifying cost reduction and eliminating staff. And I can tell you, after 2 or 3 years after that, we added back probably 25% of that staff. That's very, and to Keith's point on AI and stuff like that, we're just getting more efficient by the year.
Yeah.
And so I do think these guys are set up for potentially structurally better margins coming out of all that. I think EXPI, Compass, a lot of these guys are kind of in the same boat.
Okay. Keith, you got to follow up on that.
Yeah, it's been reported, I think, please confirm, that Glenn Stanford sold, I don't know, $750,000 worth of shares. I guess specifically, does that mean anything to you as you're analyzing a stock? And then from a macro standpoint, sort of like the question on the Zillow president, right? Like, what does it mean in general as an analyst when you see a founder or an owner take some chips off the table? So specifically, and then macro.
And by the way, Glenn, good for you.
Yeah, Glenn. Yeah, yes.
I mean,
yes, absolutely. Yeah. And if you want to take someone to dinner, Glenn, holler at your boy, because I'll let you pick up.
Yeah.
The tab.
So the first thing we always look at is this a 10b5-1 plan? A 10b5-1 plan is it's an autopilot, set in motion. I plan to liquidate this many shares methodically over time.
Clearly communicated, in advance, telegraphed.
That takes you away from the whole concern from the SEC standpoint, where there's potential insider trading, you're getting in front of bad news, like putting on autopilot. I think that's kind of what he's doing. Yep. A lot of these execs also, you got to remember, their salaries are not enough to survive in Arkansas. Right. I mean, like they're kind of paid. They're paid through stock, through compensation that way, do I love that he's selling as much as he is? No, not at all. Sure. Right. But does it cause a lot of alarms? No. Now, if
no, right.
Right. Yeah. And I'll also, other thing we look at is past behavior. We track all this crap, right? We're going to look at this historically and be like, all right, after you dumped all that shares 5 years ago, what happened to stock? A week after that, a month after that, a year after that. And so there's no real clear definitive
track
trend,
record there,
right, that causes me pause and alarm, but it's something we certainly do track and monitor.
Yeah. And he's not shy about the fact that Leo's running the show over there. So, I mean, to some degree, you're looking at the new CEO as the direction of the business. Yeah. Is that fair?
Yeah. And Leo is awesome. I love guy.
Really well.
And a great human being as well,
Yes.
But Glenn's actually very active on the international side.
Yeah.
He is helping open those international markets.
I mean, why wouldn't you want to go around the world opening up your company in all these different countries?
Right.
Sounds like an amazing idea.
Go get on the yacht, go country by country. Leo, you tackle the U.S. and all that shit that's happening over there right now.
Yeah. No, the dumpster fire that's the United States. I'm going to go to Italy and I'll see you later. Right.
Yeah. But no, I think he's still actively involved. I know from a board standpoint, all that, he's still very much in the strategy. He's still there. I think Leo is a very effective operator, and I think that's more of a credit to Leo than it is Glenn stepping away because he doesn't like the way things are going.
Yeah.
Right?
Yeah. All right. Last few minutes. We've only got a few minutes left. Real Sharon. Keith and I, by the way, love Sharon.
Another great guy.
Another great leader.
We'll have Tamir and crew at our conference next week. They're just doing everything right. I mean, there's a consumer angle to their model that they're trying to get going. The real wallet. You've got all these different initiatives. These are interesting things. I remember talking to Tamir 8 years ago, and I'm like, man, you've got 3 agents, but you're going to have a lot more over time. The guy was he's smart. He's very smart. Right. And he's got a very good team around him. As you guys know, they're just doing all the right things. Now, how much of this is I've talked about this before, like instead of 5-minute abs, we're going to go 4-minute abs, right? Like, I don't know how much, I don't know if there's another real brokerage that's coming down the pipe. I think people have tried. I think it's very difficult to be launching anything right now, but maybe they have. God, yeah. So maybe they were like the last to launch before the kind of the spigot shut off.
Storm.
Right. Yeah. And so like maybe that affords them enough time to create moats, right? Create new products and services, get close to the consumer. I like what they're doing. That's a great model.
Obviously buy.
I don't cover them.
You don't cover them. Okay. EXP you did though, right? And
I cover EXP. I'm a buyer on EXP.
And then buy it. Yeah. Okay. All right.
Okay.
Well, that's
there
Q3 earnings. There it is, folks. There it is, kids. You had a good time listening to Mr. Campbell, who now looks like he's joining the Army. And we'll look forward to doing this again in, it would be is it January? We would do it in January. Yep. So we'll do it in January. John, as always, my friend, thanks for the update on everything related to real estate stocks.
Yeah, man, it was fun. I love doing these sessions. So hope we can keep them going.
We know that everybody enjoys listening to you, so we appreciate you being here. So
thanks,
my friend. Talk to you soon.
Bye, fellas. Thank you.
Bye.
Yep. Yes, we want you to subscribe to this podcast, but the good news is if you subscribe now, you'll never have to subscribe to any other podcast ever again.